Okay, in this video, I'm gonna walk you through recording costs through the production process, doing the journal entries essentially. And I'm not gonna go with a lot of the slides, but we can certainly talk about the first one, right? So remember, if we're thinking about the beginning of the process, we have raw materials, and then that transfers over to work in process. This first journal entry is the acquisition of materials that go into raw materials. And since raw materials is an asset account, if I want to increase an asset, I'm going to do it with a debit. And then we are going to pay this vendor, right? Accounts payable. So we would credit accounts payable. Then we're going to move some raw material, right, into different production processes. So raw material is going to go into the first work in process. And then remember, in process costing, there's two work in processes, right? So the first one is roasting, and then the next one is blending. And so we're just taking raw material out of both of those and putting them into the two separate working processes, right? It's different material that we would use in the roasting process compared to the material that we would use in the blending process. And then finally, right, we are also going to take raw material and put it into overhead. Remember, indirect material goes to overhead, and then we allocate overhead to the various working processes. And so actual overhead is debited, and then we would take it out of raw materials, and it's an asset, and therefore we would credit it. This is labor, adding labor to the various elements, right? Again, we have two work in process accounts, and we have labor, right? And now labor is going into these two separate work in process accounts, roasting and blending. So work in process roasting, work in process blending, and then we are sending the indirect overhead, the indirect labor to overhead. And then we would credit factories payable, right? So this journal entry is sending labor to overhead, whereas this journal entry is direct labor going to both working processes. Exactly. Factory overhead, prepaid wages. So again, we have this overhead account, right? And we already have indirect material and indirect labor in there. And now we're adding a bunch of other things to it, right? We're going to add prepaid insurance, utilities. Maybe we will pay some things with cash, and then we will recognize depreciation. In financial accounting, it was depreciation expense, but since we are inventorying these product costs, depreciation is just going to be factory overhead. And then we would still credit accumulated depreciation like we're doing in this journal entry. But this one is all the actual overhead that we're keeping track of on the debit side of the overhead account. Right? And then this is telling us how we are allocating overhead. We are going to allocate overhead based on, it looks like we're allocating based on direct labor. And so now we are going to allocate overhead to the two different working processes, roasting and blending. And when I allocate, that is a credit to the overhead account. That is what we are doing down here. Now we can record the transfer of goods across departments to finished goods and inventory. Right, again, this one is, I want to say, relatively straightforward. We have roasting, blending, then we have finished goods. And then when we sell our goods and services, it triggers revenue and cost of goods sold. And that's what we're going to go through in these next examples. Okay. So we're moving costs from blending to roasting, right? That is nothing more than costs going from roasting to blending, right? Since they're both asset accounts, I am increasing the blending by debiting it and decreasing the roasting by crediting it. And these are the T accounts. Still with the T accounts. And now we're transferring goods from the blending, right? Where's my picture? Right now we are sending goods from blending to finished goods. Sorry. Right here. Again, roasting goes to blending, then goes to finished goods, right? In this journal entry, we are right here. We're taking it out of the blending department. That is an asset account, an inventory account. And we're putting it into finished inventory. That is also an inventory account, right? The total amount. And then if you think about finished goods, right? Finished goods is a T account, and it could have beginning balance, and then it could have cost of goods manufactured. And that's what we are talking about right here. This journal entry is cost of goods manufactured, right? And then we would have everything available to us. That is this. And then we would subtract out our ending balance to back into cost of goods sold, which is that. All right. So when I make the sale, right, we just backed into cost of goods sold, 1341,060, and that's just beginning balance plus cost of goods manufactured, gives us everything available. And then we have ending inventory, leads into cost of goods sold. And then this next journal entry, every time we make a sale, there's two journal entries that we make in a perpetual inventory system. The first one is to record revenue, right? And this is made sales on account. And then the second one is to record the cost of goods sold.